Get stuck in, I'll just run through a bit of logistics and background. So the first one there is I love to run these as Zoom meetings and not Zoom webinars because we can interact, we can see each other. So if you want to pop your cameras on, I can see there's quite a few people who've done that already. Thank you very much. It just makes me feel like I'm not talking to a screen. The other thing is my slides are over this side of the screen, which means you probably need to maximize Zoom to see some of the words on there as we go. And the other thing is have the chat box handy. So pop questions as we go through there. If I see something that relates to what we're talking about at the time, I'll generally deal with it as we go. Otherwise, if it's something left field, I might get to it at the Q&A section towards the end of our workshop this morning. And another thing, so our next webinar is actually in July. So we're going to have a bit of a break from webinars because this time of year is tax planning. The lead up to 30 June is berserk. If we were in a workshop, I'd almost ask someone for a dart because it is quite stressful. But anyway, that's what we're going to deal with between now and 30 June is getting our tax planning out the way and getting set up for a new financial year. So our next webinar will be on the 10th of July, all about improving business profitability and cash flow. So again, time of year to talk about that is great because we're at the start of the fresh financial year. What can we do to improve for the new financial year we're in? So thank you, Tay, for posting the link for that one in the chat box if anyone is keen to join there. If you haven't been on one of our workshops before, we run an accounting firm called Inspire Accountants based in Brisbane, Australia, but we work with small business owners all around Australia. We're well known for our approach to saving tax through mainly tax planning, which is the season we're in the middle of. I'm sure we're over $40 million tax saved already. Yes, Rose is giving me the nod there. Since we started counting in 2015, we've saved our clients over 40 mil. It's getting up there in terms of numbers. One of the a bit more fulfilling times a year, this one we're in right now, because we see that, what do you call it? The amount of tax saved go through the roof. Alrighty, for those who don't know me, my name is Ben Walker. I started Inspire when I was 23. I'm an award-winning chartered accountant with over 17 years experience and the author of 2 books, and they're just in the frame here. We've got the green one, which is It's All Sorted. That's more so on the topics we're talking about today, which covers sort of everything that business owners should know about tax and making the most of their tax situation. We've also got this one, Wealth for Life, which talks to how business owners might be able to build their wealth through their business and with the help of their business over their lifetime. If you did want a copy of them, I think the link will be going in the chat box in a sec. If you are a client, though, just reach out to us because we can get you a copy of that at cost. Thank you very much, Tay, for posting those links. Steve, good to see you. Cool. Oh, there's the mention of the book. So what we're covering today, the first one there is the basics of taking money out of structures. So I think to talk about Division 7A, we've got to really understand what it is, why it exists, and why in 1997 they ruined people's dreams, and then also comparing that to different structures because, it can get quite confusing. And we're also going to cover short, medium, and long-term solutions as well. The other thing as well, with Division 7A and with structures, there's no one size that fits everyone. So what I'm going to be talking about today is general principles around Division 7A, but you might have trusts in play. You might have, I'm going to talk about in my examples about a trading company, but you might have a trading trust that sends money to a company, and that's how your Division 7A exists. So again, we can talk to intricacies to a point here, but there's nothing like getting your very own advice around this. Now, for clients on the call today, obviously, happy to share through the strategies here, but to really get an understanding tailored to your position, then obviously we can have a chat with one of the accountants who are working with you, particularly around this time in tax planning, where we're looking to keep an eye on what your Division 7A loans might be doing if they exist. If you're not working with us at the moment but keen to explore that, then we've got an option for an initial chat with one of our team towards the end of our time together. Alrighty. Well, we're going to get stuck into it. First one here is the basics of taking money out. And in the context of taking money out, we've got what's the differences between a company and a trust in terms of how you get the cash out. So with a company, the first way to take money out of that, assuming it's running a business, is to pay yourself a salary. Now, if you pay yourself a salary, those super rates are a little bit out of date, but you've got to take tax out as you go, the pay-as-you-go withholding, and then you've also got to pay superannuation on top of that. And I think the current rate is 11.5%, not 10.5%, and it's about to tick up to 12. In fact, let me just triple check. I'm not giving everyone a false rate there. Let me check that one. It is important. All right, from 1 July, which is only about a month away, we go up another 0.5% to 12% super rate on top of your wages. Now, even though you're a director of your own business, you have to pay it if you're paying yourself wages or even directors' fees. I haven't seen it for a while, but there was a misunderstanding, especially earlier in my career, where business owners thought that they could get around that. But no, you have to pay super to yourself if you're paying wages to yourself. Alrighty, next one there. The next way to take money out of a company is through a loan as well, but in brackets there we've got this lovely term called Division 7A. Now, Division 7A only applies if you're taking money from a company to a trust or an individual. The Division 7A rules do not apply with company-to-company loans. There is an exclusion there, and it'll make sense as we go, but essentially companies are they can be taxed at two different rates, but generally companies are taxed at the same rate. Therefore, the Division 7A purpose doesn't exist between companies. Now, the last one there, dividends. So the third way to take money out of a company is for the company to pay the shareholders dividends. Now, dividends are typically payments of prior year profits, and what will ordinarily happen is the company might make a profit let's say in the first year, and then pay a bit of a tax bill on that. Now, companies, if they're running a small business in Australia, pay a 25% tax rate. And if you go and pay a dividend the following year after you've paid the tax, you get what's called a franking credit that's attached to that, which is basically the 25% tax bill, so that the shareholder can go and claim the 25% that's already been paid when they go and pay tax on the full dividend amount. I hope that that is making sense there. Also, Tay, I think we've got a couple of people in the waiting room. Just, yeah, thank you very much. Awesome. All right, now if we compare that to a trust, you can pay yourself a salary from a trust that's running a business as well. This sometimes happens, but it's less common because there's other more flexible ways to take money out of a trust. Now, if you pay a salary, you've still got to pay your pay-as-you-go withholding, and your super rate is currently 11.5%, not 10.5%, going up to 12% from 1 July 2025. Now, the second way to take money out of a trust is through a loan as well, but we often call these drawings. Trust drawings is the commonly used term there, and it doesn't have the same Division 7A rules at face value. So getting money out of trusts is a little bit less restrictive. And then the third one there is distributions. That's the third way to take money out. And if we have a look back a step at the company, we've got the dividends are prior year profits. Distributions generally are current year profits. So with a trust, if it makes a profit in a year, it's like a funnel. It's got to funnel out its profits to its beneficiaries. Otherwise, and so the beneficiaries pay the tax on behalf of the trust based on the profit they've received. If a trust retains profits, you're looking at almost a 50% tax rate on that the trust gets hit with. So you want to make sure those distributions, in most cases, get to beneficiaries. And that looks like paying it to the people in the family group or entities in the family group. And one of the ways that Division 7A exists is if a trust allocates profit to a company but doesn't actually cash flow that. And so therefore the trust owes the company money. That is also captured under Division 7A as well. Alrighty. And there's an example where you've got a trading trust, but you still have a Division 7A issue. A trading company. Obviously, you've got those three ways to take money out. So, yeah, what I guess our general approach is, if you're trading as a company, we pay the directors, what might be a market rate salary. It might be 120K, 140K, plus super. And then if the company makes excess profits that the business owners want to take out of that company, we look at potentially the other ways to take the money out. So, Division 7A is definitely not uncommon amongst our client groups. And I've also noticed between different clients, some clients really are adverse to Division 7A existing, and some clients don't really care. So there's, if we think of, like, there's a spectrum there, and what we want to be doing is giving the client the education around, well, you considered either end of that, and we want to give you a balanced view of what we might think is appropriate. And the idea is if you have these loans, you just need to manage them, and there's keep an eye on them, make sure they're not getting out of hand, what we might do is get into why Division 7A exists, and we can talk through more around this. So, why Division 7A was brought in? Here's my guess or my perspective. Let's say the first thing to understand is the differences in tax rates. And I'm going to use some pretty big figures here. But let's imagine you're a sole trader and you make $1 million profit, and it all has to end up in your own name. You're going to be probably paying just shy of 50% on most of that income. So in terms of what your after-tax profit might look like, I've got the estimate there at about 530K. If we compare that to a company that's taxed at 25%, you've got roughly 750 grand in after-tax profit. But that 750K is in the company's hands, not your personal hands, if you see that distinguishment. So it's a big difference. It's a couple of hundred grand in my example there in tax. And so why Division 7A exists, what they wanted to capture was people getting taxed at a lower rate in a company, but they're spending the cash that the company's built up, they're spending it personally. And they haven't essentially been taxed on it as individuals yet, given that individual tax rates are a lot higher. So someone's just popped a note to me saying that my screen share is very small. So just on that, if you make the Zoom window full screen, you should be able to see those slides there, all going well. The way it works with this one is it's not sharing a screen, it's actually sharing my webcam that has the slides on it. Hopefully that helps the Andrew. All right, so where does the money go? Because often clients are confused where they might owe their own company a lot of money. Or they say, well, yeah, I owe it 200 grand, but I don't have anything to show for it. That's a very common thing to happen. And I guess it could be a factor of many things. The first one is living expenses, especially the cost of living's gone through the roof over the last few years. That would be clear that Division 7A may have an impact behind the scenes, and essentially a bit of a surprise because you've been drawing more out of your company, or if you've got a trading trust where you owe money to a company, you haven't been paying as much over to that company to reduce the loan. The other one is sitting in your mortgage. So again, one of the biggest outgoings personally would be people's mortgages or rent if you don't own your own home, or it could be sitting on your offset account. The next one there is a property purchase or even other investments. So some people take the company's money, take it out as a loan, purchase property or other investments. The trick is if they're not liquid assets, we can get stuck with Division 7A there. And then, yeah, lifestyle expenses, which I'd sort of consider a bit of a subcategory of living expenses. You got travel, toys, boats, etc. In fact, boats are one of my in my example of why Division 7A might exist. So if we go back to again, Division 7A looking to tax the difference between an individual tax rate and a company tax rate. That's our frame there. Let's have a look at my hypothetical example of a hypothetical Clyde Palmer. It wasn't Clive who this is based on. I just thought I'd pick on him. So let's imagine you're Clyde and you've got a couple of $1 million in your company that's been taxed at 25%, and you want to buy a boat that's for personal purposes. You don't have $1 million lying around personally, so you use the company funds. There's no intention to pay back that $1 million, at least when the boat's purchased. And the key here is it's a personal use asset as well. Now, the idea here is if you don't formalize a Division 7A loan agreement for the money that you take out, then the ATO can do a deemed dividend. So basically what this means is it says, well, you've taken $1 million out. We're going to assume that that's a dividend in your own name. So here's your $1 million taxable income. And here's the tax bill attached. So 470 grand bill. So that's what we don't want to end up happening with our clients. And so we look to manage the Division 7A rules. So this legislation was brought into existence in 1997. That's when hopes and dreams were ruined. And it applies to loans after that. It's been a very long time since I've seen a pre-1997 loan on a balance sheet. If you do have one, the idea is don't pay it down because it doesn't count for Division 7A purposes. That's how we treated them, especially in the early few years of me being an accountant. They were more common because it was closer to 1997. So we'd sort of crystallize the loan there. We don't have to treat it with special requirements. And we treat them like gold. There's a few things that got grandfathered like that, and a certain type of unit trust, which was a bit of a gold mine. But anyway, they tend to close the loops on things that are fantastic. The next one there is if you do have a Division 7A loan or a loan that's payable back to a company from a trust or individually, then the loans need to be documented. There's principal and interest repayments required on that. There's a maximum term as well. The good thing is that the ATO provides a calculator for how much your repayments need to be, and it's pretty prescriptive. So essentially, we just follow the bouncing ball in terms of getting those repayments sorted. The issue, though, is a few years ago when the interest rates were so much smaller, the Division 7A interest associated with loans was a lot less. But obviously the cash rate's gone up. Thankfully, it's come down as well, and it may even go a bit lower, who knows. But the idea is that now, in current year, we're looking at like 8.77% interest on these loans. And depends on what you've pulled the funds out of the company for, but some of these, the interest that you pay back to your own company may not be tax deductible to the borrower. If you've drawn the money out for a tax deductible purpose, yes, it is. We could tax deduct it in the borrower, but the company needs to also pay tax on the interest it receives. So again, where our interest rate is 83% or so higher than it was a few years ago. And so sometimes these interest bills can creep up, especially if the Division 7A bills are quite large. I've got a question that's popped through. I might answer that with, so James has popped a question there. Couldn't Clyde set up a trust and purchase the boat through there as a side hustle, Clyde's boat tours? Now, assuming that Clyde's boat tours is purely a business related activity, then that wouldn't be seen as personal funds. But even then, because the company is borrowing is lending money to a trust, we still need to consider it as a Division 7A issue. So if I was Clyde and I wanted to set up a boat business where I'm taking people on tours with my $1 million yacht, I would set up another company so that I've got a company to company loan that does not have Division 7A stuff associated with it. And then assuming, we could go and claim all the expenses related to that, assuming there's no personal use on that one. So, yeah, that's my comment to your question, James. So what are the rules with Division 7A? Well, if your loan is unsecured, meaning there's no property security, then you've got a 7-year loan term to repay that. If you have a secured loan, now that has special requirements. You've got to have certain loan to value ratios for that. But the good thing is you've got 25 years to pay. Now, the difference between the two is not the interest rate, but it comes down to your minimum repayment each year. So your minimum repayment on a 25-year loan will be a lot less than a 7-year term loan. And again, it applies to distributions from trusts to a bucket company that hasn't been paid in cash. Now, there is a case going through the courts over the last little while that, and the courts have actually sided with the taxpayer on this to say that even if you've got trust distributions payable to a company, that shouldn't be a Division 7A loan. So I do want to flag that. So they've sided with the taxpayer saying that doesn't count for Div 7A, but I'm not getting my hopes up because that is definitely not the ATO's stance for the last 28 years. And I guess the unpaid present entitlement to a trust, under any work we've done in the past, has to be converted to a loan at a certain point. If they go and unwind, like if the ATO is unsuccessful in holding their position, then the expected outcome there is they'll actually go to change the law to include these loans, so or these unpaid present entitlements. So if you're holding on to that, I would hold on with low hopes, unfortunately. So what do we do about the Division 7A loans? We've got short, medium, and long-term solutions, which is good. So the short-term solution is actually paying back the money. That's the first one there. So just pay the money back to the company. That's easy, loan repayment. Now, this doesn't technically count as a repayment if you rip the money back out in early July. It's a very common practice for this to happen, but it is not a repayment under the rules around Division 7A. And so if you're doing this, I'd suggest you immediately stop and work something else out, whether it's just the minimum repayment or whatever. So yeah, again, that's the first one there. Medium-term solutions, that the minimum repayments on an unsecured loan are paid back in cash, or if you don't have the cash to put back in, we can actually issue dividends for the amount of the repayment as well. Or sometimes we issue salary to a director, but not actually pay the cash and offset the loan for the amount of the repayment. So with dividends, we've got to consider franking credits as well that you might be able to get. And with salary, obviously, when we pay a salary to a director, we've got to pay super on top, and we've got to take tax out of that as well. So that is the next one. And that can apply to the 7-year loans or the 25% loans. The next medium-term solution is that you have cascading loans. So for each year that drawdowns happen from your company to a non-company related party, you can track them in separate loan accounts, so that, let's say, and it's not uncommon for clients to have, a 2022 financial year Division 7A loan that's separate from their 2023 loan, their 4 loan and 5 loans. So you might even have a few Division 7A loans. And what we do is make sure the minimum repayments are met on all of them. But the idea is that when you split them like that, you've got 7 years to repay from the start of each loan, not just the first one, if that makes sense. So it can help with the management of the repayments there. Cool. Alrighty, so I've got a couple of questions here. So Brooks asks, when do you start paying interest on it? So you pay interest. So let's say you're drawing down money in the 2025 financial year. We've got to consider your Division 7A and look at repayments and interest next financial year. So you don't need to pay them immediately. And James has said, clap, clap, clap. Hello, Dubai. Yes, more and more clients are moving to Dubai. For sure, I have seen that. It's a lot simpler there from a tax perspective, and they don't shaft you so much, is the message I have heard. So, yeah. There's another question from Rajiv. What if Clyde buys a primary place of residence or investment property with the money and buy it under a trust name? Would that be classified as Division 7A or personal use? Rajiv, yeah, both examples you've given there. If you're taking money from a company to a trust or individual name, yes, it needs to be considered for Div 7A. Yes, you don't get an exemption. And I'll give some even long-term solutions, or it might even be in the medium ones here of how we might want to structure that. Pardon me. Sorry, Julia has asked a question. I'll go back one. Julia's asked, what is the point in which it must be converted to a loan? So again, I'll give the example of money drawn out this financial year. We should be turning that into, well, that will be a loan on the balance sheet at 30 June 2025. But if you're paying trust distributions to a company, and they're owed at 30 June 2025, that would be an unpaid present entitlement. What we treat it as for the first year, it's essentially a UPE or unpaid present entitlement, not a Division 7A loan. But by 30 June 2026, a year later, it will be a loan, if that makes sense. So, yeah, again, if you're unsure on how it applies to your exact structure, just have a chat through with your accountant there. Next solution here is the minimum repayments on an unsecured loan. So what you're doing is you're building up the loan knowing you'll pay dividends to repay later. So where we see this is, and I guess at the end of the day, Division 7A is you're taking money out of a company to spend personally. You're not getting taxed at the time you've taken it out. So you're deferring the tax bill. Now, if nothing else changes, you're deferring it. But in this example, I've given the example of you're coming up to retirement or a business exit. So that means you're not going to be drawing down so much money out of the company because it won't be coming in anymore. And what that often looks like with clients is their overall group taxable income will reduce. So then they can start paying bigger dividends after the exit or at retirement to start paying back those loans faster and faster. So again, that's another one we look to do depending on the client situation. Alrighty, next one here, long-term and/or permanent solutions. Well, obviously the permanent solution is pay the cash into the company. But the question is that a poor use of funds or is that not in alignment with your plans, hopes and dreams? If that's the case, maybe there's other options. Paying the top-up tax. So, if clients really hate Division 7A and we want to get rid of it and they're happy paying the top-up tax, we can make that happen. And what that looks like is, the company's probably already paid the 25% tax, so we get a franking credit for that. We push the amount that's outstanding over to an individual, and they pay the difference, assuming they get a franking credit, which is the difference between probably what they're on at 47% less 25. So, you want to get rid of 100K Division 7A loan, pay a dividend for it, and you might be looking at about 22K in tax on that at the time. Now, this is a strategy we use for high income family groups, which is actually buying investments in a company anyway. So again, remember how I said earlier that company to company loans do not attract the Division 7A stuff. Well, the answer here is put the cash to the bucket company or whatever company is owed money and then invest through that. Now, I wouldn't do it through a trading entity. That would be silly because trading entities have risk associated with them. You don't want to get sued in your trading entity and lose your investment property or your share portfolio. But yeah, we can structure this so that you've got an asset related company that doesn't trade, and you start purchasing property or shares or managed funds through that. Where we look to this sort of strategy is where there's a group family taxable income of about 400 to 500K or more. This is one of the ones we start considering at that stage. It can be earlier if there's a bit of a fast growth business behind it, or a lot of cash lying around where we know that we're going to have a Division 7A problem pretty soon. Um, Another long-term solution is to take an unsecured loan and secure it with property, but you do need equity in a house to do it. I can't remember the exact LVR rates. It's not ridiculous, but that's something that where we turn a 7-year loan into a 25-year loan, so we have a smaller minimum repayment each year. Alrighty, just reading a question there, James. So a holding company can loan to another startup company to purchase assets without a Division 7A repayments and interest and all that bollocks being required. That is 100% correct. Company to company, no Division 7A, which is handy. But what I'll also throw in there is if you've got a holding co which doesn't trade, you've got protected assets essentially because you don't have business risk. So if it's going to lend to a startup or going to lend back to a trading company for working capital or anything like that, I'd suggest talking with your lawyer about doing a secured loan agreement so that if something happened in the business, you're able to claw back what was lent as a secured creditor before it gets divvied up if there's anything left for unsecured creditors. So yeah, the key with the one on the screen here is shifted over to a secured loan is your minimum repayment will drop, which means your top-up tax each year for the minimum repayment will decrease as well. This one is a fantastic option for that happens to help with Division 7A, and I'm in the middle of a pretty hectic one at the moment, but it's basically restructuring your business. So the one I'm working on now, the business is run through a discretionary trust, and it's been running for quite a while. There's value in the business, and we want to actually shift that over to a company to run the business because a discretionary trust can't have other owners in it. And one of the big drivers is they want a management team to buy into this one. So I'm just trying to work out where my notes are here. But the goal is, or how Division 7A works with that is the first step is we value the business to see what it's worth. And let's say it's worth $2 million. The new company needs to pay the old trust $2 million for that. But what we're doing there is the new company is probably set up with a $10 balance sheet, the shares issued for $10. And so the company has to borrow money from the trust that's selling the business to it. So we call that vendor finance. And what we're doing in that sense is that we're creating the opposite of Division 7A, where the new co owes money to a trust. Now that's the opposite, which means we don't have to apply these interest rates or anything like that. But what can happen in the future as the trading company starts earning its own income, paying tax at 25%, we can start repaying the loan back to the trust out of profits that have been taxed at 25%. So we don't have to pay the top-up tax on repayments of loans, if that makes sense. So this is great to get a bit of to get ahead on Division 7A, or where a client's got a Division 7A loan. Like let's say, hypothetically, we're looking at this $2 million business sale, but the client already has a 500K Division 7A loan in their scenario. What they'll do with that $2 million purchase is done right. We've got the 2 mil it owes less the current 500K Div 7A debt equals we've got the 1.5 mil still owing. So we're getting rid of the Division 7A loan that exists and then getting ahead on it with the balance of the money. So yeah, quite. These can get very complex in terms of how we apply them. And then the other thing you've got to consider with a restructure is you've got a capital gains tax bill or potentially stamp duty considerations, depending on what state you're in. Queensland is one of the states where we still have stamp duty on business transfers. There are concessions or exemptions in certain cases, though. And then if you're in New South Wales or Victoria, the good news is there's generally no stamp duty on business transfers, which is handy. So where are we going from here? The other benefit of a restructure like that is you can reset the cost base for your business. So I'll sort of repeat that. If we put ourselves in the shoes of the new trading company that's just bought the business, it's just paid $2 million for the business, and if it sells the business, a few years later for 4 mil, instead of paying tax on 4 mil as a gain, we're going to pay tax on 2 mil and have to work through that. So that's another benefit as well. And there's often ways to restructure. The initial restructure where I said the trust sells to the company for 2 mil. Technically in the books of the trust, that's a capital gain because it's sold a business, but there's often ways to reduce that capital gain through the small business capital gains tax concessions, and even the general capital gains tax concession if you own an asset for more than 12 months. And the benefit there is your CGT bill should be a lot less or even zero in some cases, depending on certain factors. Like the one that I got a private message about then. Very good. Cool. I've just gone through this bit before. So just giving you the example of a 2 mil purchase with a $10 company. Very good. Well, I've spoken a lot of jargony things, and hopefully I've simplified where I can, so that it's sort of making sense. But there might be a fair bit of questions that come through. So what I'm going to say is feel free to pop your questions in the chat box and I will work through them. That's the end of my content. Again, I'll get to Q&A in a sec. But if you aren't working with us currently, and you want to explore what it looks like, even if you've got the Division 7A dramas that we're talking about, the next step to explore working with us is to book an initial chat with one of our team. And you can do that with the link in the chat box, or the link is inspire.accountants/chat. We can have a look through that. So yeah, what we're going to do, sorry, and if you are a client on the call, Division 7A is a discussion that we have during tax planning, and we can have a further chat. And the other thing is, if you want to talk more about a restructure, definitely flag that with the accounting team. Alrighty, over to the questions. So James' question, who does the business value for the sake of compliance? So yeah, we do need a business value. We do them using basically valuation methodologies. We've got the valuation essentially is for reference for the tax office to make sure if in the case of audit we've transacted at a market value. So we can't go ridiculously over or ridiculously under for the benefit of the client. We've got to be independent to some point there. Rajiv, the CGT 50% off event not applicable in a company if we buy property under a bucket company. Yes, you're 100% correct there. Companies do not get the 50% general CGT discount, but they get usually a very concessional tax rate. So depending on the circumstances, you might be paying 25% or 30% in a company, versus if you get a CGT discount in a trust or personally, and it's a big gain, you're going to be paying 47% tax. The difference here is you don't get a franking credit on your 47%, but you do in a company. So when you look at the long-term dramas of managing Division 7A in a trust or an individual versus the tax saving right at the end where you pay it and don't get a franking credit, usually, and this is where high income family groups, we look to structure investments in a company and forego the CGT discount. So yeah, again, it's a good point you brought up, but yep. And the other thing is, especially where the client has a very long-term view of building a portfolio and not selling, then CGT is less of an issue. And we get all the benefits along the way of, missing out on all the crap that goes with Division 7A. Alrighty, next question. So Peter has asked, so we can invest the full amount outstanding in Division 7A by the bucket company, and that pays the loan off. I'll repeat back sort of what I've heard there. So you've taken the money out of a company, and then we go, well, hang on, I want to buy investments. Um, what entity do I do it in? Yes, if it's back in the bucket company, we repay the loan and then invest from there. There will be no Division 7A on what I just said there, because assuming that the loan is cleared by you putting the money back in. So yeah, that is definitely a strategy. Okay. Oh, here we go. Ah, dear. I've got a direct message here that talks about offshore stuff. Okay, so I've got my resident heckler on online here, just sending me a Division 7A, or nothing to do with Division 7A, I reckon, but more about offshore structuring. But actually, I did get a question in the pre-submitted question fields about purchasing property, etc., offshore. We do not cover that in the scope of what we help clients with, but what we do there is look to link our clients up with an individual tax advisor, sorry, an international tax advisor. And it depends on which country they're looking at for the asset, because obviously, yeah, certain advisors cover different jurisdictions. So, yeah, if you are exploring that, then yeah, we need to work in part. And often where we've got international clients, there'd be a local accountant in Australia where, if they've still got activities here, and that's us, obviously, there'd be a local accountant in the country that they're buying in or living in, whatever it is, and then there'd generally be a third advisor who covers the sending money back and forth, how the structure covers, I guess, that higher level structuring um, there. What's the top three countries for your recommendations? I don't recommend, well, I guess essentially with international stuff, if you're an Australian resident for tax purposes, you're taxed on your worldwide income. So we've had clients where they've built up investments and assets in Australia. They've done so through companies or trusts, and and their trusts still remain a resident of Australia because long story short, they've got a company trustee which was set up in Australia, so the trusts are still resident. Um, so, and then yeah, we've had clients move overseas, start businesses over there, completely unrelated to their Australian entities, and start earning income overseas. So yeah, again, it's extremely complex with international structuring. So yeah, if it's something you're looking into, then yeah, I recommend chatting to one of those international advisors. The countries we've seen a fair bit of is Dubai. I just found out another client's considering moving there today, and we've already had 3 or 4 move already. The other one is Thailand. And James, my second international international tax question heckler. Good stuff. Yeah, so Thailand, we've seen a few, and then Bali. I've heard they've got some sort of visa, but I just don't know how that interacts with the Australian tax residency. Especially, I don't think the visa is necessarily permanent. It might be a few years, but anyway, yeah, Dubai. Yeah, I've seen Dubai a few times recently. It used to be thrown around the words of Cayman Islands and things like that. I haven't heard that or BVI for a very long time. International waters on a boat. Yeah. Yeah, if you're domiciled there, well, you're not here. You're not in Australia. All right, Varun has popped popped a question there. If a property held in a trust is sold with the 50% CGT discount, can that discount be transferred into the bucket company? No. No is the no is the answer to that. So when you've got a trust that distributes a discounted gain to a company, you've got to gross it back up to 100%. So unfortunately, we can't do that. Um, yeah. All righty. Well, that's all the questions that I've seen pop through in the chat box. Um, I guess from here, I might leave you all to enjoy the rest of your week. Thank you, James. Dear. Thanks very much, James. And yeah, again, thanks everyone for joining. Again, if you've still got questions, please reach out to the team, and we can work through a workshop what the best scenario for you might be. All right. Thanks, Kim. Thanks, Chloe and James. Cheers. Thanks, Galen. All righty. Let's get that sensational song back on.